Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Zeta Global, ticker symbol ZETA, closed the session on January 30th, 2026 at $18.58. That's down 4.57% for the day.
And the volume behind that drop was heavy, which tells me there was real conviction in the selling. We're looking at a stock that is currently trading in a massive, volatile 52-week range from a low of what, 1069 to a high of 2660. Right now, it is sitting significantly below Wall Street's absolute lowest price target of $25. But to be fair to the ticker, the broader sector was ugly today. SAP and ServiceNow posted mixed earnings, and that dragged the entire software index down with them.
It certainly did. But I see this specific price action as a massive dislocation. We are talking about a company that has hit the rule of 40 on free cash flow metrics, is projecting 34% revenue growth for the year, and is leading the absolute cutting edge of the transition to agentic AI. The market is punishing them like a distressed asset when the fundamentals suggest a high-growth disruptor.
See, I come at it from a different way. I see the price action not as a mistake, but as a rational response to a very complicated risk profile. You have a company facing active litigation, stock-based compensation that is, frankly, excessive, and the lingering dark shadow of a damaging short seller report from late 2024. The market isn't stupid. It's pricing in the baggage.
Baggage or noise? That is the question. Today, we're debating whether Zeta is a misunderstood, undervalued AI marketing cloud poised to double, or a high-risk asset plagued by complexity and reputational issues.
Let's get into it.
I want to start by laying out exactly what Zeta has become, because I think the market, and perhaps you, are lagging in understanding the fundamental shift here. This isn't just an email marketing company anymore. Zeta has successfully transitioned into a full-blown AI marketing cloud via the Zeta Marketing Platform, or ZMP. And the proof is in the execution. They have delivered 17 consecutive quarters of beat and raise performance. In this economy, that level of consistency is incredibly rare.
Consistency is great, provided the quality of the earnings is there. But before we get to the financials, explain the AI marketing cloud claim. Everyone puts AI in their investor deck now. What is actually under the hood?
The engine is what they call their 4 pillars. But the most critical one, the one that acts as the electricity for the whole machine, is their proprietary identity graph. We're not talking about a simple email list here. We're talking about granular data on 245 million individuals in the US and over 535 million globally. While competitors are panicking about the death of third-party cookies and losing signal, Zeta is sitting on an amalgamation of proprietary and authenticated signals. 2,500 attributes per profile. They know who the customer is, what they want, and when they want it, independent of Google or Apple.
You say proprietary identity graph, but where is that data coming from? In a world where privacy regulations like GDPR and CCPA are tightening every single month, relying on a graph built from third-party signals feels like building a castle on sand. I mean, if Apple changes one setting on the iPhone, or if a new privacy law passes in California, does that electricity get shut off?
That's the beauty of it. It's not third-party dependent in the way you think. It's primarily first-party data opt-ins. But the real differentiator, the thing that makes this a moat and not just a database, is how they're using it for agentic AI.
Okay, stop right there. Agentic AI is the buzzword of the month. Define it. How is this different from the generative AI that writes a spam email?
Huge difference. Generative AI creates content. It writes the email. Agentic AI does the work. Through their partnership with OpenAI to launch Athena, they are building software that doesn't just recommend an action, it autonomously executes it. Think about a marketing manager. Usually they have to look at the data, decide to run a campaign, write the copy, select the audience, and hit send. Athena does all of that. It sees a trend in the identity graph, it agents a strategy, creates the content, and executes the media buy across channels without a human hitting a button. It chains tasks together. This is a structural shift, and the market is pricing them like a legacy vendor.
That sounds incredible in a slide deck. But practically speaking, this agentic future assumes a level of trust that most enterprises just aren't ready to give to a piece of software. You're telling me a Fortune 500 CMO is going to let an AI autonomously spend their media budget? I don't buy it. And speaking of buying, let's look at the competitive landscape. You paint Zeta as this unique snowflake, but they are fighting a war on multiple fronts against absolute giants.
They are carving out a specific lane.
Are they? Or are they just mediocre at everything? Look, if I want the best programmatic advertising, I'm going to the trade desk, TTD. Reviewers, ad buyers, agencies, they consistently prefer TTD for paid media because it's pure, it's transparent, and it works. If I'm a merchant on Shopify, I'm using Klaviyo. Why? Because the integration is seamless. It takes 5 minutes to set up, and it just dominates the SMB and mid-market space. Zeta is trying to do email, CTV, social, and web all at once. They risk being a jack of all trades, master of none.
You're looking at it through the lens of fragmentation, which is exactly the problem Zeta solves. You mentioned the Trade Desk and Klaviyo, great companies. But if you're a large enterprise, do you want to manage the Trade Desk for ads, Salesforce for CRM, another tool for email, and another for social? That is data silo hell. The One Zeta thesis is about unification. They aren't chasing the Shopify mom-and-pop shop that Klaviyo serves. They are chasing the Fortune 500 who are tired of stitching together 6 different SaaS products.
And yet, Salesforce is the 800-pound gorilla in the room. You can't just wave them away.
I'm not waving them away, I'm comparing the growth. And this leads us to the valuation disconnect, which is where the bear case really falls apart for me. Zeta trades at an enterprise value to sales ratio of roughly 7.49. They are growing at 34% post-Marigold acquisition. Now look at Salesforce. Salesforce trades at a premium multiple, yet they are growing at a lethargic 9 to 10%. You are paying more for less growth with Salesforce. With Zeta, you are getting a high-growth asset at a mid-cap price.
7.49 is not cheap, my friend. The market average for this sector is around 4.46. You are paying a premium. And you can't compare them to Salesforce without acknowledging that Salesforce is a cash flow machine. Zeta is not.
But Zeta is getting there faster than you give them credit for. They acquired Marigold for $325 million, which immediately added $190 million in revenue and 40 Fortune 500 clients. It was immediately accretive. And they hit the rule of 40.
Let's pause and define that for the listeners because companies love to throw that metric around.
Fair enough. The rule of 40 is a standard SaaS metric where you add your growth rate and your profit margin. If the number is over 40, you're considered an elite, healthy software company. Zeta is clearing that hurdle. And look at their net revenue retention, or NRR. It's at 111%. That means if they didn't land a single new customer this year, their revenue would still grow by 11%, just from their existing customers spending more. That proves the product works.
NRR is a solid metric, I'll grant you that. But let's look at the profit side of that rule of 40 equation. You are relying on adjusted EBITDA to make that math work. They're targeting $385.4 million in adjusted EBITDA, but adjusted is doing a lot of heavy lifting there. It strips out the very real costs of running this business, specifically stock-based compensation, SBC.
Every tech company uses SBC to attract talent.
Not like this. We are looking at a projected $190 million in stock-based compensation for 2025 alone. That is massive relative to their revenue. That is real shareholder dilution. We are talking about a projected 3 to 4% dilution in 2026. If I hold this stock for 5 years, my ownership stake is being significantly eroded just to pay the staff. You're buying growth, yes, but you are paying for it with your own equity. This is why they don't have GAAP net income. They aren't actually profitable in the real world. They're only profitable in the adjusted world.
I'm not convinced by that line of reasoning because the cash flow is real. They're generating cash. The SBC is a non-cash expense. But I know where you want to go next. We have to address the elephant in the room, the reason the stock is $18 and not $30, the Culper Research Report.
We absolutely do. You cannot talk about Zeta without centering the discussion on that report from November 2024. And we need to explain what was actually in it, because short report sounds abstract. The allegations were incredibly specific and incredibly damaging.
They were allegations.
Let's look at them. First, round tripping. For the listeners who didn't read the 50-page dossier, round tripping is effectively circular financing to fake revenue. The allegation was that Zeta would pay a third-party vendor for data or services, and that vendor would immediately turn around and use that same money to buy services from Zeta. It creates the illusion of revenue growth where there is none. It's financial alchemy.
A claim that was thoroughly investigated.
And the second prong was even worse for their reputation: consent farms. The report alleged that Zeta operates a network of deceptive websites, think Win a Free iPad-style sites, designed solely to trick users into handing over their data. Then, Zeta supposedly takes that data and sells it as high-quality, opt-in leads. If that is true, their identity graph isn't a proprietary asset, it's a regulatory time bomb.
Okay, you've laid out the nightmare scenario. Now let's look at the reality of the response. Zeta didn't hide. They didn't just issue a generic, "we disagree" statement. They issued a detailed, point-by-point 15-part rebuttal. They hired an independent forensic review firm, Latham & Watkins, and external forensic accountants who conducted a deep-dive investigation and cleared them of the round-tripping allegations.
Companies always hire firms to clear them. It's what they pay for.
That is a cynical take. But actions speak louder than words. Zeta put their money where their mouth is. They authorized a $100 million share buyback program immediately following the crash. Companies that are actually committing fraud, who know the books are cooked, do not drain their cash reserves to buy back their own stock. They hoard cash to pay legal fees.
Or they buy back stock to artificially prop up the price to prevent a margin call or a complete collapse of confidence. I'm not giving them a gold star for a buyback. A company growing at 34% should be reinvesting that $100 million into R&D or acquisitions, not financial engineering. To me, a buyback signals they were desperate to stop the bleeding.
If they were desperate, why is the smart money doubling down? This is the strongest signal of all, and you can't ignore it. Goldman Sachs increased their position by 368%. Vanguard and BlackRock hold massive stakes. Institutional ownership is sitting at around 88%. These institutions have compliance departments, they have forensic accountants, they read the Culper report, they did their due diligence, and they decided to buy the dip. Are you saying you know more than the risk desk at Goldman Sachs?
Institutional ownership is comforting, sure, but institutions get it wrong all the time. Look at Enron, look at Wirecard. They were full of institutional money until the day they went to zero. And this brings me to the leadership. Trust is a major factor here. CEO David Steinberg.
A visionary serial entrepreneur.
Or a man with a checkered past. We have to look at the history. Steinberg founded Infonix back in the day. That company filed for Chapter 11 bankruptcy in 2007, shortly after he resigned. There were controversies with the FCC regarding deceptive practices. History has a nasty habit of rhyming. When you have a CEO with a bankruptcy on his resume and a company accused of deceptive data practices, it paints a picture.
That was 20 years ago. People evolve, businesses evolve.
Maybe. But look at the recent insider activity. We have family trusts associated with leadership filing to sell about 1.53 million shares. That's roughly $31 million leaving the table. Now, the PR team says it's for estate planning, and maybe it is, but when your stock is down 4% today and trading at the bottom of its range, and you supposedly believe in the agentic AI future, you don't sell $31 million worth of stock. You hold.
Steinberg still holds over 24 million shares. He is heavily aligned. The sale is a drop in the bucket of his total holdings. And regarding the legal fallout, the class action lawsuits resulting from the short report are standard procedure. Every time a stock drops on a short report, ambulance-chasing firms file suits. They're currently waiting on a dismissal decision. It's a tail risk, sure, but it's not an existential one.
It is a risk that hangs over the multiple. That is exactly why the stock is stuck at $18. The market is waiting for the other shoe to drop.
Or the market is offering a rare window of opportunity. Let's talk about the potential return here. Let's play out the investment scenarios. Let's say a listener puts $5,000 into Zeta right now at 1858.
Walk me through the math, but keep it realistic.
Short term, let's look at just 1 year out. The average analyst price target, not the high, the average, is $30.26. That is based on their 2026 guidance and a normalization of the multiple. If they hit that, your $5,000 becomes roughly $8,156. That is a 63% return in 12 months.
That assumes they hit the guidance and no new scandals emerge.
Now look at the long term. This is the agentic AI thesis. If they hit their 2031 projections, and if they trade at a mature SaaS multiple, the stock could reasonably hit $70. That turns your $5,000 into nearly $19,000. That is a 277% return. You're getting a chance to buy a unicorn builder at a massive discount because people are scared of a short report that has already been debunked by forensic accountants.
That is a beautiful spreadsheet, but let me apply a reality check. You are completely ignoring the volatility. Zeta has a beta of roughly 1.3 to 2, depending on the time frame. That means when the market sneezes, Zeta catches pneumonia. It falls twice as hard as the index. We saw that today. Market mixed, Zeta down 4.5%.
High beta works both ways. It rallies harder too.
That's the problem. If the sector rotation out of software continues, or if we get just one regulatory fine, one GDPR slap on the wrist regarding those consent farms, that downside is significant. The profit you're projecting is theoretical. The volatility is very, very real. A prudent investor looks at capital preservation first. This is not a stock for capital preservation.
No, it's a stock for capital appreciation. It's for the aggressive part of the portfolio.
It's a gamble. A calculated one maybe, but a gamble.
Well, let's try to pull this all together for the listeners.
Here is my summary. Zeta is an impressive revenue story. I can't deny the growth numbers on the board. But it is complicated by a black box of data privacy issues, a litigious past, and a reliance on non-GAAP metrics to show profitability. You have a CEO with a bankruptcy in his history and massive insider selling. The potential for profit exists, absolutely, but it requires a stomach for massive volatility and a sort of blind trust in management. To me, it is a show-me stock, not a trust-me stock. I need to see clean quarters without legal noise before I touch it.
And I see it as a rare dislocation. The shift to agentic AI is the biggest catalyst in a decade, and Zeta is the only mid-cap player combining proprietary data with the execution capability of OpenAI. The smart money, Goldman, Vanguard, they are buying the dip caused by the short report. They see the value. For a 3 to 5 year horizon, the risk-reward ratio is heavily skewed toward the upside. You are buying growth for pennies on the dollar relative to its peers.
I think we can both agree that the Q1 2026 earnings and the actual public launch of Athena are going to be the deciding factors here.
Absolutely. If Athena works as advertised, the game changes.
And if it doesn't, that $18 floor might get tested again.
It's going to be a fascinating quarter to watch.
Indeed. Listeners, you have the data. You know the risks. You have to decide if the growth outweighs the baggage.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.